Welcome to the Transparent FX Academy. I'm Nick and I'm a top author on TradingView with over 190k reputation points. In today's video, I will be sharing a simple yet effective swing trading strategy on the 1 hour time frame. Now, as usual, to keep the video as educational as possible, first I will be covering all the technical rules of the strategy, trying to keep the video as educational as possible. So going through all the scenarios, how to adjust the strategy to your own trading needs and trading personality and how to develop it. Then we will also speak about how to integrate the strategy with order flow. And by the end of the video, we will be putting everything together and trying to bring this as further as possible. So I really suggest that you take advantage of the entire video, watch it till the end, and I will see you on the charts. Okay, so first of all, let's start from the directional rules of this strategy idea. Now, when it comes to the time frame, first of all, 1 hour time frame, as I have already said previously. So any chart, always 1 hour time frame. The second thing that we need to speak about is the rainbow indicator. Now, this indicator essentially creates every single EMA and puts it on the chart. You can see here I have written all the EMAs that this rainbow indicator puts here. 2, 3, 4, 5, 6, 7, 8. You have essentially 200, all the way up to the 200 EMA, all on the chart. So many EMAs here, all plotted on the same chart. And you have the different colors. The quickest EMAs will be yellow, blue, and green. Then you have red and purple. Those are essentially the slowest EMAs, which are also the ones that we are most interested in. We will see that later on when we dive deeper into the rules of this strategy. The third thing is the COT data that we have to speak about. And now I will also explain how to put all of these together. Now, the COT data is the commitment of traders. So essentially what the non-commercials, so institutions that don't have direct interest in that market from a business perspective, and they are just into the market for speculation. Now, these are the biggest traders, so hedge funds, institutions, and what usually people refer to when they're speaking about traders as the big players in the market, okay? Now, they're forced to report their positions. They don't like to do it, but they're forced to report their positions by regulators. And this software that we have here at Transparent FX essentially automatically pulls the data when it is released and displays it in this easy to read format with all the colors and very well arranged. Now, what we can see here is that you have on the right column the net positions. Now, when you're looking at net positions, like let's take Euro USD for example, what you can see is that net positions are either increasing or decreasing. For example, from minus 47k, they were increasing all the way up to 146k, and then they started decreasing again all the way down to 134k. Now, net positioning is essentially longs minus shorts from an institutional perspective in the market. What this shows is that you can gain an idea of whether institutions are moving to the bearish side of the market or if they're moving to the bullish side of the market. And what we want, obviously, is to only be trading in the same direction as the COT data, because that is the direction that has the highest probabilities. Because if you have the biggest players in the market that are putting their orders in a specific direction, there is a higher probability that the market will go in that direction. So we only want to be trading in their same direction. That is the last thing that I want to speak about when it comes to the directional rules. Now, we have to put all these rules together. What do I mean by this? We have to define what it classifies as a valid direction by using these three criteria. So we are in the 1 hour time frame. We want to see where the COT data is indicating. So let's say, for example, we look here that the COT data, from the COT data, the net positions have been decreasing lately. And in fact, price started dropping to the downside because institutions were adding shorts, were moving to the short side of the market. Then we have to check the rainbow indicator that we have here on our chart. Now, what we can see here is that the rainbow indicator was cutting for short. Now, this indicator is in the short side of the market, so it's bearish if you have the yellow at the bottom. It is bullish if you have the yellow on the top. So essentially how the EMAs are twisted depending of whether the market is in a bearish state or a bullish state. An easy way to do is just look at the yellow color. If the yellow is on top, you have a bullish market. If the yellow is on the bottom, you have a bearish market, right? So by looking at these three things, you go on the 1 hour time frame. You put the rainbow indicator on the chart. You check the CO2 data. In this case, from here, we had 1 hour time frame, CO2 data looking short, rainbow indicator looking short. Perfect. So we know that essentially here, we could only be looking for shorts because our directional rules were only looking for shorts. At this point, it's time to move to the second part of this tutorial, which explains essentially the entry rules. So now that you know the direction, you're only looking to take shorts. How do you actually take those shorts according to the rules of the strategy? Now, when it comes to entry rules, is always simple. There are essentially the rule for entry, the stop loss rules, and the take profit rules, okay? Now, when it comes to entry rules, as I was explaining previously, the rainbow indicator will put on the chart the slow EMAs and also the fast EMAs. What we're interested in is the slow EMAs, so red and purple, specifically purple. The reason is that when the market is in a bearish state, and we have already identified that the market in this section here was in a bearish state because according to our directional rules, the market here was in a bearish state. If you already have determined that, you want to have a market that goes and hits the slowest EMAs, so essentially becomes overextended to the upside in a bearish market, because at that point, that is where you have the highest probabilities of getting a reversal away from the area, right? So every time that the market is testing the purple EMAs, that is where you want to see the market reverse, because you have a bearish market which is overextended to the upside, and at that point, you expect more bearish continuation in the market to continue to the downside. So that is where you have the possibility to find the highest asymmetric risk to reward trades, right? And we will be speaking about risk to reward in the later section, where we will be speaking about the risk management rules of this strategy. So what we have to identify at this point is which are those entry rules. Now, first of all, since we know that we only want to be looking for shorts and we only want to be looking for shorts in this overextended region, it would make sense to have a situation in which we're looking to short the market, for example, with a sell limit order, when the market reaches that purple overextended to the upside zone. Now, when it comes to stop loss, it would make sense to have the stop loss placed well above the end of the overextended region, right? We know that the overextended region ends here. We want to have our stop loss well placed above this zone. Now, when it comes to the take profit level, it makes sense, as we will see later, to have a minimum risk to reward of 1 to 3. So essentially, when it comes to take profit, we want to have at least a 1 to 3 risk to reward. So our entry would essentially be, for example, on the test of this overextended zone, stop loss would be way well above, and take profit would be at a 1 to 3 risk to reward from the entry to the stop loss zone. Right now, this can be fine-tuned with backtesting, but that is something that we will be speaking about later on in the last section of this tutorial. Now here, when you have a market which creates such a huge move to stop hunt, essentially, there is no way to have this be a winner. This is always going to be a loser because you have such big volatility. So it's not even important to speak about it. This is definitely going to be a loss. Here, once again, in this bearish market with all the rules that were bearish, the market went and tested once again our purple zone, our overextended to the upside zone, stop loss above the high with a nice 1 to 3 risk to reward. We can see how in this case was another very nice 1 to 3 risk to reward win. Here, again, the market tested its zone here, and once again, stop loss above the high according to the rules that we're now developing. take profit for a nice 1 to 3 risk to reward. Once again, another winner. And at the moment, the market would be once again testing this zone. So we can see how, obviously, sometimes there will be moves like this with huge stop hunts, but most of the times, if you have a market which has the CO2 data line to the bearish side, the 1 hour time frame is bearish, you have the rainbow indicator that is on the bearish side, and you are shorting the overextension to the upside of a bearish market, you have the possibility to catch some pretty big risk to reward opportunities, 1 to 3 minimum, with a move to the downside. Now, let's keep going. Now, when it comes to risk management rules, now risk management is essentially defined as the minimum risk to reward, which, as I was saying, is 1 to 3, and I will now explain why, and the risk per trade. Now, why it is so important to have at least a 1 to 3 risk to reward? Now, let's say you have a strategy which is performing very poorly. You only have a 30% win rate, okay? So 30% win rate means that out of 10 trades, okay, you have 10 trades, you will lose 7, so you will have 7 losses, 7L, and you will have only 3 winners, okay? That is essentially a 30% win rate. Now, if you have a minimum risk to reward of 1 to 3, you're still going to be profitable even if you have only a 30% win rate, because those 7 losses, okay, those 7 losses will essentially, if you're risking 1% per trade, will be minus 7%, right? However, those 3 winners, since you have a 1 to 3 risk to reward and every winner is 3 times the amount that you're risking, you would have 3 times 3 is 9, so you would have plus 9%. So total, you would essentially, even with a terrible win rate of 30%, you would still have a plus 2% overall on a 10 trades essentially streak, only winning 3 out of the 10 trades. That is why it's always very important to have a proper risk to reward strategy. And in my opinion, a proper risk to reward strategy is having at least a 1 to 3 risk to reward. Then risk per trade can easily be 1%, 2%, whatever you want. However, in my opinion, it's very important to have a 1 to 3 risk to reward. Now, I want to move to how to develop a proper trading strategy. Now, all these entry rules, direction rules, not really the risk management rules, but mostly directional rules and entry rules, must all be fine-tuned when you're actually looking to develop a strategy, right? You have to adjust everything to make sure that you're trying to maximize the effectiveness of a strategy. This is just an idea of a potential strategy. Now, how do you do that? You do that with proper backtesting, with then demo trading until you're consistent, and only then you can start thinking about going live. Now, how do you backtest? You backtest by looking at a chart and applying your rules over and over again over a massive amount of trades, 100 or more. At that point, you can start having an understanding of how the market moves while applying that specific strategy. This gives you the possibility to fine-tune and tweak the rules and adjust them to try to maximize the performance of the strategy, whatever it may be. So in this case, you would be taking the directional rules, entry rules, testing them in the past over and over and over again, try to understand how you could increase the performance of the strategy. By the way, you can see here exactly the opposite of what we have seen here. Here we were having essentially everything bullish. The market was testing the overextended to the downside zone with a bullish market. And you can see how many times the market tested its zone and rejected it to the upside. Obviously, you will have situations in which this doesn't apply, like for example, we had here. But in the majority of the cases, the market tends to respect this zone. And that is why I wanted to share this strategy idea. But now, as I said, it's your job to develop the trading strategy, integrate it with what you already have, and you can take this as an idea of something that you might want to put together and elaborate further. Now, if you want to learn more, I really suggest that you go and check out the transparentfxtrading.com website. Here, you have the possibility to gain access to my entire course. It's the most complete, all-inclusive mentorship program that I have ever created. Here you have an entire video presentation of exactly what you get, all the courses, services, softwares that you get in the all-inclusive mentorship program. In fact, You have the possibility to gain access to all my trading courses: risk management, day trading, swing trading, scalping, position trading. You also have the possibility to gain access to one-on-one private mentoring, the VIP market breakdowns with the Telegram signals, the COT data software, which is the one that we used in this video, the trading station software, which puts together everything that you need as a trader all in one interface, the account funding program, in which we essentially give you a scholarship and cover the fees associated with taking a challenge at a prop firm. And if you continue scrolling down the website, you will see that you have the possibility to join and start a registration to becoming a student here at TransparentFX. So I really suggest that at least you go and check it out at transparentfxtrading.com. The link will also be in the description. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free analysis education and updates for all of you. And I will see you in my next breakdown.